Hello and a very happy new year to all of our listeners. Welcome to our first investment webinar of 2023. My name is Rebecca Cretney. I'm an investment counsellor here at Nedbank Private Wealth, and I'm joined today by our Chief Investment Officer, Tom Caddick. Tom and I are here to provide a review of 2022, a year which, quite frankly, most market participants will be relieved to leave behind, and to look ahead at key themes impacting markets this year. So a very happy new year to you, Tom, and thank you for joining us.
Pleasure as always.
Before I get started, I need to cover off some compliance requirements. It's important that you understand that the information provided here is for your personal use only and shouldn't be taken as advice or as a recommendation. We include details of investments that may not be suitable for you, and this material has not been approved by or registered with any relevant government authorities under the local laws. You should seek individual advice from a professional advisor before making any investment decision, and more details as to these points will be shown at the end of the presentation. Last but not least, please ask any questions throughout the session. We will try to answer any quick questions during the main discussion itself, particularly if we mention something that isn't clear to you. But we have got time set aside at the end of the webinar to tackle the rest of your questions. You can ask questions using the question box in your control panel. And in the event that we don't have time to cover all questions, we will email the answers to those who ask the question. In addition, you can rest assured that you will remain anonymous, so the questions will not be attributed to those posing them. So, on today's rather busy agenda, first we will be reviewing the events of 2022 and the actions that Tom and the team have taken across portfolios. Be talking about what went well and potentially what didn't go so well. We will then look at performance before turning ahead to the issues that you probably all want answered, and that's what do we expect from 2023, and will it be any different to that horrible year that we have left behind? So, turning now to the main events of 2022, it was a year that was dominated by inflation. Inflation came about as a result of a number of different things, which Tom will undoubtedly touch on, but dislocation caused by COVID, Russia's invasion of the Ukraine, and then the inevitable rise in interest rates as central banks over the world tried to tackle that inflation. Tom, can I ask you to tell us a little bit more about 2022? And whilst you're doing so, to talk to us as well about what we did across portfolios to mitigate against the risks that we identified.
Sure. I mean, I think we sum it up here. I mean, it was a very challenging year. It was a challenging year for investors. It was a challenging year for professional investors, people trying to read the markets. And that was across a couple of lines. But if we roll this back all the way to the beginning of 2022, we already started to see some inflation in the system. So it's not as if that was a huge surprise, but I think the extent of inflation was. Now, going back to sort of January of last year, what we're starting to see is some supply side inflationary pressure coming through. If anyone can bother to remember the Evergrande tanker that was, shipping goods. I think it was in the Suez that got stuck. I sort of think of that as being one of those forerunners. I think that was in 2021, one of the forerunners to that supply side pressure that we were starting to see, which was the wrong goods in the wrong place at the wrong time, as the whole of the global economy started to restart. Started to fire up the engines. We sort of factories reopening post-pandemic, etc., etc. And that is a whole supply chain that needs to re-establish itself. So those supply side inflationary pressures were starting to come through. In addition, and sort of meeting it headlong, you had demand-led pressure coming through on inflation, which was really, again, that post-COVID, post-lockdown environment of, in many cases, people with pent-up spending, ready to push back into the market, almost start living again. So you had those two areas coming together, and that was causing something of a squeeze, but it looked manageable. And we can talk about how you might manage that. The real shock to the system came with the Russian invasion of Ukraine, largely because this has stopped being now a sideshow. Ukraine is responsible for a significant amount of food production, certainly input, raw material production, things like wheat, certain oils, etc., which you take those out of the supply chain, and that had created a significant ripple effect in terms of supply side inflation coming through, prices rising. At the same time, you had the West's response to Russia, which was all of the sanctions that were imposed. Most of those really, the ones that really hit home for most of us in the Western world, come through in energy prices. So taking out that natural gas production and supply for many of the Western economies suddenly created this huge influx pressure on energy prices. So you had the big supply side inflationary pressure now pushing in, still meeting demand-led inflation, which is why we went from elevated inflation to significant levels of inflation in relatively short order. And clearly the central banks had to respond. Now, what do the central banks do? In reality, they don't have many tools available to them. But in terms of inflation, they're looking to try to tackle, or what can they tackle? It's demand. It's demand-led inflation. So what does that mean? Well, it's through interest rates. You put interest rates up to try to stifle spending, which is that more demand-led, encourage saving, etc., etc. That's only looking at one side of this inflationary equation. You've still got this big pressure coming through. You also had a very strange environment where economies were still growing, although albeit slowing, and that's what they're looking to do. They're looking to try to slow things down to keep a lid on inflation. You still saw that growing. You saw the labour market still looking incredibly tight, way beyond what would normally be deemed as full employment. All of that still creating this inflationary pressure, both the demand and the supply side. But that's the challenge that the central banks have had for much of 2022. And that's much of the challenge that as an investor, we've all been asking ourselves, which is, we know interest rates are going up. We know why they're going up. What we don't know, or have to try and interpret, is how quickly and how far interest rates are going to move. And that's been the challenge. But when you get that sort of environment where you've got central banks looking to stifle demand, effectively growth, where they're walking a fine line between trying to keep a lid on inflation and try not to kill off any growth, therefore shift into a recessionary environment. There's a fine line, particularly when you've had inflation at levels that probably most people haven't seen in their working life, let alone those within central banks. So you've had that pressure going on, and at the same time with interest rates going up, that has a knock-on effect in terms of the way in which assets are priced. And that's been the big story. So that really tough market conditions that we've not seen probably for about 60 years have been that coordinated downward move in both equities and bonds. Now, not getting too technical about it, but what we see with the bond market is if yields are going up, in other words, the base rates are going up, central banks are putting their prices up, so therefore the yield or the income that you expect from the bond market goes up accordingly. With that going up, the prices have to go down. There's a perfect inverse relationship. So that's what you've seen in the bond markets. There's been other factors at play like default rates and things like that, but that's been the main shift. Yields going up, prices going down, and at the same time, you've had some big gyrations in equity markets as investors try to maybe seek out some degree of safety, which has been very challenging to find, and at the same time have been trying to adjust their valuation models to reflect a new sort of interest rate environment. And that's been the big story of the year. You've had all of this geopolitical noise in the background with the terrible events in Ukraine. There's been some significant moves going on in China. Some from the geopolitical side, we've had worries around a potential conflict in Taiwan, which hasn't gone away. I suspect that with the events in Ukraine have probably pushed that one down the road a little bit, particularly in terms of the force of the Western response. But you've also had a zero COVID policy that has been driven in China for much of 2022 and going into 23, which has effectively meant that the manufacturer of the world, the factory of the world, as it's often referred to, has been sporadically shutting whole provinces down on a couple of people sneezing, and that has caused a sort of a further ripple effect in terms of inflationary pressure on the supply chain. Again, going back to that, you've got the wrong goods in the wrong place at the wrong time. That causes supply side inflationary pressure. So those have been the big stories of 2022. And what has that really resulted in? It's resulted in this sort of coordinated weakness in both equity and bond markets across risk assets generally, as investors have tried to reprice and reposition and re-understand exactly where they are and how they should be invested. So that's been the story of the year. I'm going to pause for breath, Bex, just because I think you wanted to also talk about the portfolios and how we've tried to navigate the path. But any thoughts from you at that point?
Well, it was exactly where my thoughts were heading, because you've described a perfect storm of equity sell-offs, of bond sell-offs, and as most of our listeners will be aware, there was pretty much nowhere to hide, or very few places to hide, save the dollar. So it was a very, very difficult environment to navigate. And so, of course, my next question was going to be, how did you navigate it?
So you have a plan. You know, we have our investment process, we have our positioning, and our positioning is based on where we believe we are, but more importantly, where we believe we're headed in terms of the economic backdrop. There are certain factors that will influence prices now, and then there are certain factors that influence prices in the future. Things like valuation levels, they tend to be a longer term factor to play out. Some of the more near-term factors that influence asset prices will be the economic backdrop, what we're seeing and how you're interpreting it. As I said at the start, we started the year in one place and things changed. Things changed primarily on the geopolitical front. So we started the year with a sort of a mixed read. We could see that valuations were starting to look quite stretched going into the year. So we'd sort of been already moderated some of our positions, and we had tilted towards more value-oriented equity strategies for portfolios, largely in the belief that that sort of momentum growth area of the market, the Amazons, the Pelotons, whatever of the world, of this world, were looking quite stretched from a valuation standpoint. And then on the fixed income side, our reading was Interest rates are at historic lows. They had been for some time. Fixed income wasn't really doing what we want it to do in a portfolio, which is offer some form of defense. It can only offer defense if you've got a yield that can change and respond. And we couldn't really see that with fixed income. So we'd already moved to what's described as a very short duration position. And what I really mean by that is we'd taken out a lot of the interest rate risk from our exposure within fixed income, because we could see interest rates being at such historic lows. And we were taking our risk for clients really in areas like high yield. So short duration, so low interest rate risk, high yield. So this is sort of below investment grade, not speculative high risk, but below investment grade type areas where you could still generate a reasonably attractive income. And how do you do that? It's because the underlying is slightly more risky than government debt, for example, or investment grade corporate debt. So that's where we were taking our risk and getting returns for portfolios. Now, as the facts changed, as we saw that geopolitical picture unfold, specifically in Ukraine, we could see an environment where we were starting to see real upward pressure on inflation and therefore interest rates, and then the knock-on effect that may have. So what we started to do is value actually did on a relative basis very well. So our equity positions on a relative basis were doing well, albeit in absolute terms, the markets were selling off. So we started to reposition ourselves within that space where we saw value do so well. We started to reposition equity holdings towards more of a quality growth side. Now, what do I mean by that? Quality growth are areas that are more resilient to a recessionary environment, have better margin protection built in, maybe higher barriers to entry, that might be more across things like non-discretionary spending from a consumer standpoint, those sorts of areas which tend not to be really exciting names like a Microsoft or a Unilever, but can give some resilience, particularly in a recessionary environment. So we started to tilt positions there within equities. On the bond side, on the fixed income side, as we saw yields rising, so not just seeing central banks moving up their base rates, but actually the important thing is less about that, it's more about what's the market pricing in, what's the market expect. As we started to see that expectation shift upwards, we started to buy interest rate risk again. What does that really mean? Well, we moved away from high yield, because in a recessionary environment, you might see upward pressure on default rates, i.e. businesses going bust. We moved away from that type of risk, credit risk, and went into interest rate risk. The idea being that what we're really looking for is not trying to call the top of an interest rate cycle, but trying to move your positions so that you can benefit from a position where you're either maintaining interest rates or you might start to see those coming back off again. Hence, we moved to take on some of that risk. So within fixed income, we really positioned ourselves much more towards government debt, mostly treasuries, so US, as well as investment grade, and took on some interest rate risk as well. So we moved the position of the portfolios quite dramatically, really, over that time. And if we're starting to see rates peaking, I don't mean if the central banks raise them again, we expect them to, but it's what the market is predicting. So the market has already predicted and priced in rates that are higher than they are at the moment. So what we're really looking for is to see that starting to come off. So if we start to see that come off, the portfolio should do well. And in the meantime, we're picking up a much higher income level than we would have a year ago. So that's what we've been up to. Now, the really interesting part of the portfolio over the past year has been our exposure to real assets, to alternatives, those areas that can behave slightly differently. Now, our reasons for owning those, and we were talking about it this time last year, this time 18 months ago, about inflation protection, those sorts of things, and it all sounded incredibly boring. And then you get inflation at 10%, and it stops sounding that boring. And you want that in your portfolio. And that was one of the reasons that we owned things like renewable energy. Renewable energy, as we'd always said, gives us exposure to a really sort of long dated type of, good line of sight in terms of earning stream, but it also gives us a linkage to some degree of inflation protection, and specifically energy prices. Now, did we predict the shift upwards in natural gas and therefore electricity? Not at all. We're not suggesting that, because that has been very specific to an event, and that event was the Russian invasion of Ukraine. But we were aware that that would give us a degree of inflationary protection for the portfolio, and that came through in spades last year. So we saw that particularly in the first 6 months. We started to see inflation really ramping up. The prices and the upward shift in price on some of those assets that we've got in portfolios was quite remarkable. So we saw sort of 10, 20, 30% shifts on some of those assets, and that is directly linked to that. Those areas have been really interesting. There are lots of things we would, you wish you did differently, or you might have altered, but that was I think a real positive for the portfolios in 2022. Likewise, our positioning, where we started to shift it less, away from some of the more cyclical. So when we say cyclical, we mean things that are more attuned to economic activity and the economy, and more towards long-dated, high visibility of earnings, areas such as where we prefer infrastructure, things like that, which gives us, not terribly exciting, but it gives us a really good earning stream, long-term, good visibility of earnings, some degree of inflation protection. We had that at the start of the year, but we did start to tilt the portfolios as well into those areas. Again, I will pause for breath.
Thank you very much for a very quick summary of what actually amounted to a lot of actions taken across portfolios. It was an atypical year, in that there was far more activity in portfolios than one would normally expect to see. So you've actually managed to summarize it very well. Perhaps we could turn now to the next slide, which I believe actually gives us some numbers surrounding what went on, because we've been talking a lot about events and we've forgotten the numbers. But Tom, could you perhaps point out the data that you feel our listeners need to know about? Here we've got equity markets.
I mean, this really does highlight just how there was nowhere to hide in that period. Now, you might zoom in on, say, the FTSE 100, or and look at that on a year to date. This is looking at it as at the end of December. So realistically, year to date, 1 year is almost the same thing. I think it's the 29th we close it at here. You might hone in on one of those markets. Now, this is in local currency. So if we were to look at, say, the FTSE 100 in dollar terms, that would look very, very different, given the weakness of sterling over that period, or certainly the strength of the dollar in this period. But this just highlights the extent of some of the moves that we saw. So, for example, if we're, as a dollar investor, if I'm looking at the S&P 500, this is the creme de la creme in terms of market cap, in terms of size, globally, let alone within the US. And you saw a shift downwards of 18% on the year. That is a really significant shift downwards that we've seen, and that will vary. Again, there really haven't been, if we look at some other areas like Europe, or which is a downward shift, doesn't look as aggressive as, say, US, but in reality, that's in euros. And in dollar terms, that would be very significant in terms of its downward shift. So there really hasn't been anywhere to hide over that period. And there are lots of stories that go within it. You know, areas such as emerging markets, which at times looked really awful, closed the year, you know, not a million miles away from some of the Western economies, but have been really significant shifts. Now, if we move on the slide, I think we've captured some of the fixed income markets.
Yep.
And here we go. And this is the key message here. For example, global aggregate. Now that's a predominantly sovereign-based and investment-grade type index that is capturing there a 16% fall in value, give or take a percentage point or two. That's in line with equity markets and the sort of shift. Now, bear in mind that traditionally you would own fixed income within your portfolio as a defensive quality for your portfolio, as a degree of insurance within your portfolio. And that is a significant shift. Now, there are lots, as I said, lots of stories within stories here. Interesting, for example, TIPS. You have TIPS there, that's an inflation-linked bonds, down 12%. I mean, that you'd ask the question, why is that? Well, that's because actually they saw a lot of their shift upwards in 2021 and in the closing period of that time. And it's an incredibly long dated asset. So although you've got some inflation protection built in, a lot of that had come through. And at the same time, given that it's a long dated asset, you've got then the linkage to interest rates moving upwards, which has absolutely smothered the benefits of having inflation protection there. So hence those two sort of component parts have fought against each other. But for me, this just demonstrates the extent of the moves that we've seen and the coordinated nature of those moves. Now, I'm very aware that the sun is now shining into my screen, and if anyone can see me, all they can probably see is this sort of almost angelic halo over my head, for which I apologize. But for me, I think that's the key point here, Bex.
Yeah, so in light of all of this sea of red, which you've pointed out, the FTSE was the only hiding place really. But if you look over the longer term, and you'd been owning the FTSE for the longer term, that wasn't the place to be necessarily either. You would have missed out on a heck of a lot of growth from US markets. So I guess the next obvious question is, how did our portfolios perform in light of this turmoil? So
I think we're capturing here, yes, absolutely, some of the sort of the turns that we saw. So that sharp downward movement in markets and the coordinated nature of that downward shift. Now, we're showing here, largely due to ease, you know, the performance of a couple of our funds that we manage, which are effectively a mirror of our discretionary portfolios. You know, we're never going to crack open the champagne when you outperform on a downward market, because we're very cognizant of the fact that our clients have lost money in this sort of environment. But at the same time, we take some comfort from being able to have outperformed on the way up in 2021, and we've outperformed on the way down in 2022. Now, it's a challenge in these sorts of markets, and it's very easy to get whipsawed. And what do I mean by that? It's very easy to get caught out on wrong positioning and then getting caught on how to reposition, which is why you need and I've said this and practiced this for the last 25 years, you need a strong and robust investment process to adhere to. because it's in times of market turmoil or market shifts when it is very easy to get caught out by big swings in markets. If you get on the wrong side of that and then getting pushed into and pushed away from your investment process, it's what we sort of would call investment drift, or process drift, beg your pardon. It's what we would call process drift, and we are, you know, adamant that we want to always maintain a strong investment process that we can adhere to. So it's pleasing to see the fact that, you know, both of our, well, all three of our key strategies and our discretionary portfolios have outperformed during this period of turmoil, and significantly at times, but it really has been a very challenging time to perform. And we should never forget the fact that 2022 was a very challenging year for assets generally.
I'm conscious of the fact that we've only got some 15 minutes left in our webinar, and we have had a couple of questions come through, but they're big ones. So I'm going to leave them for the end, because I think that you might in part answer some of these now. But let's now turn our sights to the big question on everyone's mind, and that is 2023. Is it a new year, and therefore everything resets? Investor sentiment certainly seems to be improving. What do we think 2023 might bring?
Yeah, I think it's always an interesting one. And we were talking about this sort of earlier in the week, which is, as you go into a turn of the year, you can't press reset. That's not how markets work. You know, first of January does not represent a new economy and a fresh start for the economy. It is where it is, and both globally and locally and regionally. However, the turn of the year does give you a point of reflection. So it is that traditional time to look at your positioning again, try to look at it with some fresh eyes, maybe reflect on some of the things that have worked and some of the things that haven't. But where are we? And we try to think about this on an ongoing basis, as you would expect us to, from a process perspective. There are certain key themes that are absolutely still relevant and still worthwhile talking about. COVID-19 being less so these days. Now, this is something we talked about at the turn of last year, where we were expecting and anticipating a shift to a more endemic status for COVID. And that has played out as we would expect. I think the thing that has surprised us has been China and its refusal to shift to a sort of a more open environment, has maintained this zero COVID policy that has stifled certainly some of the progress in terms of supply chains. Now, where are we and how do we look forward? Actually, things have started to open up. So we're starting to see that absolutely endemic scenario for major nations in terms of COVID, but we're also starting to see China be more tolerant. Now, part of that has come down to pretty much a failed vaccination program that they would never be willing to admit, but was the reality. But have started to soften their stance on COVID, which can only be good over the medium term for supply chains. It can still cause some disruption, and that's what we anticipate in 2023, certainly the early phases, but we don't anticipate COVID being a major factor, other than still some of the fallout. In terms of geopolitics, will remain, I think, acutely front and center in our minds. But in terms of influencing the global marketplace, it is difficult to predict, and we're not going to try to predict any sort of resolution to the Ukraine crisis and that conflict. But those events will have a material impact on markets generally and the inflationary picture. So we can see that. We've said here the likelihood of a widening involvement from the West. We saw that coming out of the UK just this week in terms of supply and support. I think the key challenge here is more of an attritional one if you see this sort of continued attrition coming out of the war, and how that plays out in terms of the impact of Western economies and Western populations as to where those sympathy levels lie, will have a direct impact on the level of involvement from the West. But we're not here to try to predict geopolitics, but clearly it will play a major factor in 2023. We do expect volatility to remain in markets. We've seen volatility levels, and this is really just talking to the level of swings and sort of oscillation in prices that we see. We do anticipate elevated levels of volatility, certainly for the first half of the year, but more likely going in for the 12 months, which creates opportunities as well as threats within markets. So we shouldn't get too carried away about thinking of that as a headwind. But it just creates a different environment. Now, you could argue actually that creates a more conducive environment to outperform or find performance or create alpha, as we call it. But and that is certainly the case. Inflation, I think a great question, and I saw one of the questions coming through. Have we seen inflation finally slayed? Are we seeing that under control? Well, our read is it's very easy for us to sit back and say we have certain certainties over the coming 5 years. We know inflation will come under control. We know that it will peak, and we know that it will come down. The key questions are when, at what level, and how fast will we see it moderate, and what price do you have to pay to moderate it in terms of recession, in terms of negative growth in global economies. What is our read? Well, we expect inflation to remain relatively high, but we do believe that we're starting to see signs now of peaking inflation. Now, let's not forget, what is inflation telling us? It's telling us what's happened rather than what will happen. And there are certain sort of base case factors that will feed through into inflation, like a spike in energy prices. Big spike in energy prices has a ripple effect in terms of inflation, and then as that feeds through the system in terms of manufacturing having to increase pricing to accommodate higher energy and input costs, that has a ripple effect. But it's when we look at our inflation rates, it's telling us what has been. So some of those ripple effects we've now seen coming through, and in fact, although it's nothing to cheer about, other than sort of a wry smile, the latest numbers from the UK, where we saw a slight dip month on month as well, it's worth noting, in inflation rates, it's still double digit. So let's not get carried away. But we're starting to see that, and that's largely due to that ripple effect now having taken effect from energy prices, and we're starting to see those come off. So what does all of that mean? Yes, we believe that we're starting to see peaking inflation, which is a positive, but not anticipating a sharp reversal. We can expect to see those elevated for a period of time, but coming down. We did say at the time, I think a couple of quarters ago, that there's a big difference between, let's say, 8% inflation that has dropped from 10 and 8% inflation that's risen from 4 or 6. When you're starting to see inflation come under control and dip, you should expect to see sentiment starting to pick up. So those are the big those are big factors. So you can still see elevated and high levels of inflation, but fundamentally that can be okay if it looks like it's under control and falling. Central banks, another key factor. From our perspective, we do anticipate to see some further rate rises, but so much of that is now priced in. Now, the big question for many has been, when does central banks pivot, as they call it, i.e. move from being this sort of fairly aggressively looking to control inflation and therefore stifle growth, to being more dovish, or in other words, being supportive of growth and loosening up on their inflationary controls. Upward, downward movements in interest rates, in other words. So we're not anticipating a significant and sharp pivot from central banks, and there we're really talking about the Fed, Bank of England, European Central Bank, etc. We don't expect a sharp pivot, but we can expect to see them as the year progresses, starting to just ease off a little bit in terms of their rate hikes, and that is being priced in already. Absolutely, economic growth we can anticipate being slow, lower, slightly more anemic for a period of time. We have got concerns around Europe in particular, and I include UK within that, where you've got some very specific factors coming in from the proximity to geopolitical issues in Ukraine, in terms of energy supply, high inflation, which you're seeing particularly in the UK, where you've got also the fallout of Brexit factors. Added to that, the tighter monetary conditions that the central banks are putting. But economic growth, I mean, we can expect to see relatively anemic growth for the duration of 2023. Recession, as I said, that's one of the big questions, and in some cases is more of a technical question than a really particularly relevant question. So, recession is really about a sort of consecutive periods of negative economic growth, and whether you have growth at 0.01 or minus 0.02 is kind of immaterial at times. Anemic growth is how we see this. Clearly there is risk of policy error from central banks, i.e. being too aggressive in terms of their inflationary control and therefore smothering growth. But we find ourselves in this strange positioning here, and we've asked ourselves, what are the chances of a soft landing? What are the chances, and by that we see, of central banks being able to curtail inflation, get inflation under control without smothering growth? And that is a fine line for them to tread. And in 2023, that's going to be a particular focus. But if we're starting to see inflation levels coming off, we see this strange environment where we've got anemic growth, we've got very tight labour markets, we've got high inflation, that you run the risk of moving into a stagflation environment, which is high inflation or elevated inflation, negative growth. What we're looking for from central banks is to try to navigate, and it's a fine line in 2023. We do prefer areas such as the US, which are, I think, better placed. Inflation is more under control. Labour market still looks tight, but it's starting to loosen slightly. There's probably more scope for progress there.
So let me ask you about a little bit more about that, and a little bit more about how our portfolios are positioned going into 2023.
In terms of positioning, equities, we are, we have to be cognizant of the headwinds. We've seen something of a bounce on year to date, but let's not get too caught up in a couple of weeks worth of market activity. We've tilted our positioning towards quality growth, and we've maintained that position going into 2023. We are, when we think about things as overweight, underweight, we are underweight equities. We've still got exposure and significant exposure across portfolios because we understand that that is the growth engine over a longer period of time. But we have reduced some of our exposure to equities with a tilt towards quality growth, which is really reflecting this idea of a more recessionary environment, or certainly anemic growth environment. Fixed income has been an area that we've shifted from being really out of love with for a period of time to now really finding quite attractive fixed income markets. So we have shifted our weightings in fixed income to now sort of build out positions. But importantly, we've shifted up in terms of the exposure to interest rates that we have there. So most of our exposure within fixed income is within government debt, but with interest rate exposure sensitivity, because we anticipate that we will see, once we start to see that peaking, we will start to see markets pricing in a dip or downward trajectory in interest rates, and we will benefit from those for clients. So Fixed income does look attractive, and in the meantime, we can pick up an attractive level of yield. Real assets, and I'll happily talk about the things that we wish we had done for portfolios, just like we talk about the things we did do. But we do like real assets, specifically infrastructure, and that's a continuation of our themes. We have been tilting away from things like commercial property towards areas such as infrastructure, largely because it gives us some of that inflation protection, less sensitivity to economies, and good visibility over the long term. Alternatives, we've talked about this a lot. We still like alternatives. We've been slightly frustrated by progress in some of these asset classes that we have within portfolios, where they just feel mispriced. But they do give us some credible diversification for the portfolio, as well as some baked in inflation protection, which again, we like. Cash is almost a byproduct in many cases. It's almost a byproduct of what you're doing elsewhere in the portfolio. As a long-term investor, I don't like cash. I like risk, and that's the nature, and that's what we're paid to do. But as a byproduct of a slightly more challenging environment, we have increased our cash levels, and also partly as a byproduct of some of our positions. But we do see that we're getting increasing opportunities in the market to be able to get that money back to work again. So, with the rising yields and higher market volatility, we said here, it makes it less unattractive, which is obviously clearly a double negative. But it's hard to say that cash is particularly attractive. It's just that it does give us that ability to then put the money back to work in terms of risk.
Perhaps I could ask you now to tell us what are the tailwinds that we see and what are the headwinds, and to weave into that, if you can, when you see an opportunity to start to change the makeup of the portfolios.
Yeah, I mean, we've summed it up here in terms of tailwinds, headwinds. And you look at this and you'd say, well, this is terrible because there are so many more headwinds than there are tailwinds. Although that said, clearly these are just lines on a page of factors, and each factor will have a greater or lesser influence on positioning. But clearly there are probably more headwinds from an investor standpoint at the moment than there are tailwinds. Having said those, tailwinds are the upshot of a falling valuations is that valuations start to look far more attractive once you've adjusted for base rates, etc. But valuations do look far more compelling, and in some cases fair, and in some cases compelling. We've also started to see sentiment shift, which from our perspective starts to give us some of those sort of early signals of maybe good opportunities to take in. But we should always be cognizant of some of these headwinds, which are significant. So that tighter monetary policy and those conditions that factor in high inflation, slower economic growth are really certainly very key factors. The geopolitical backdrop is significant and will have a sort of shorter term but very near-term influence on markets. I think you were asking, well, what is it that we're looking for? So let's just summarize a couple of things. Number one, portfolios have risk in them. They have to have risk in them. We have exposure to equities, certainly where we can. We have exposure to equities. We have exposure to risk in our fixed income positioning. We need all of those things to generate a return over a long period of time. And being slightly more cautious on the markets currently doesn't mean that we are overtly negative on the midterm outlook. Actually, if I look at this in the mid to longer term outlook, I'd be extremely positive on markets because I do anticipate this sort of transitory phase to wash through, and we'd expect to start to see strength coming back into markets. But we're looking for some evidence of this being sort of less speculative money that's creating these sort of gyrations in markets, to start to see some true evidence of inflation coming under control, as opposed to just starting to see some evidence of the potential for peaking rates of inflation. Now, we would err towards actually probably the former, which is that we're starting to see that come under control. But we need to start seeing that really wash through to start to get really more positive. I think where we're positioned at the moment is, and how we feel is that we really like fixed interest at the moment. We really like some of our alternative real assets. Equities, we know as a growth engine for the portfolio. And we are ready to go to start to reinvest, but we're going to be selective. We don't want to be pushed into it whilst you've got these sort of significant headwinds with a lack of visibility on how that could wash through. So realistically, I think to answer your question, we want to see some hard evidence of inflationary pressures coming under control, and some evidence coming through from central banks that we're starting to sort of more of that transitory shift back to a more sort of supportive environment.
Thank you very much, Tom. I think my key takeaway from everything that you've said is that volatility does lead to opportunity, and that volatility is just a normal factor of investing. Our portfolios are diversified to such an extent that permanent loss of capital it simply isn't feasible unless for some reason you need to remove your money from the portfolios, or unless, which is the most common reason for crystallizing a loss, investors panicking and pressing the trigger button. I have to say, I have been thoroughly impressed by the sheer resilience of our clients, staying the course, completely cool-headed, and in fact accepting volatility as just that normal factor of investing. It's been one heck of a year. But you wouldn't know it by our investors' behavior. They've been cool as a cucumber, as they would say. So thank you very much to all of our listeners and to all of our clients. I'm very sorry that we weren't able to answer your questions live. We will respond to them individually, so that rest assured they will be answered. And it just remains me to thank Tom for his kind participation, and to wish you all a very happy and a very prosperous 2023. Thank you.
Absolutely. Take care.